I know Santiago usually has some spicy takes, but it was nice to hear the monologues and rants, not just in tweet form like we usually see on the timeline, but him actually really expressing his view long form, just casually stream of consciousness. What did you think of everything, Stephen?
We need more Santos. I know I asked him, does he think he's unique in crypto? Is he relatively contrarian? He's like, no, like I think he is. I don't talk to many people who, I guess he's got a level of professionalism, but also kind of clarity of thought to actually apply himself into crypto. Yeah, you don't see that too often, especially like I think we didn't talk about market conditions, but right now it seems like we're kind of close to the bottom or it's bottom-ish. So there's a large shakeout. So I think there's even less Santiagos than there were before. But no, it was good to let him roll with things. I think this is the most listening I've done on a podcast versus participating in dialoguing or asking, coming at him with spicy takes. So it was really interesting. I think especially with the inversion approach, I think it makes a few good points about specifically the why now around how to use blockchain to actually upgrade parts of the financial workflows or financial infrastructure of the world. So yeah, I mean, his story is also just starting 12 months in. Like, it's exciting times.
I want to harken back to one of the things you said about clarity of thought. I thought it was interesting, the consistency as well across various different aspects of whether it's markets, valuing things, thinking about AI and how it's used at his firm. It's really, really cool to see that in real time and him kind of also explain that to us. So yeah, I think this is going to be a good conversation that the folks at home will enjoy because it's very seldom you hear investors talking about how to ask the right questions and things of the sort. So yeah, this was awesome. Hello and welcome to Layer 1 Podcast. My name is Kelvin Sparks. This is my co-host, Stephen Gates, co-founder of Hypha. Joining us today, we have Santiago R. Santos, founder and CEO of Inversion Capital. Welcome to the show. How are we all doing?
Thanks for having me on, Kelvin, Stephen. Great to be here.
Great to have you.
So before we begin, Layer 1 is a podcast focused on the intersection of crypto and the real world. And it's brought to you in collaboration with Avalanche. Nothing we say on this podcast is investment advice or financial advice. Make sure to always do your own research. And in today's episode, we'll be talking about equities versus tokens, among various other topics with Santiago R. Santos of Inversion Capital. So without further ado, maybe a quick icebreaker, just because we're going to get into some deep stuff today. FDV.gg. It's a really, really fun website that you put together. I thought it was really, really cool. So it seemed like obviously it was geared towards the different investor profiles and whatnot, understanding your risk tolerance, how you like to get exposure to different markets, which is really cool. But one of the things I thought that was interesting, you like Bitcoin at 2 trillion versus Facebook at 1.5 trillion. This was a while back in the reply guy kind of thing. So I'm curious, is that still the case? And if so, can you explain why one more time?
Yeah, I mean, I think the first of all, it's pretty amazing. I've had these ideas that I wanted to build, and then like without AI, I would have needed to go to an engineering team and build this, and I built this over the weekend in my spare time, very limited spare time, but it's really remarkable what you're able to do, and so I find myself just like truly amazed in the state of the world that we're at, where I can just spin this up, and the interesting thing is that like it will collect answers. It starts with a medium, and then it collects answers based on the consensus, just adjusts. And then it narrows down the set of questions based on what you select, and then we'll identify flaws in your judgment. So typically, like I think it's a transient property. So if you select A over B and B over C, you should select A over C. But sometimes investors like select C over A, and so that's like a violation in judgment. So I obsess about behavioral economics, and I think markets are generally very inefficient. And a lot of this was like inspired by like discussions that I've had with people within crypto that are deeply like fanatical. And but like when you think about like the investable universe is not just crypto, right? So you can go and invest in a number of instruments. And so I think that when you frame it like that, I think a lot of people would say, hey, do I really want to own Ethereum at 300 billion? Or do I want to go buy XAI if you can find it in the private markets, or even public companies, right? So as an investor, like you're in the business of making like absolute returns. And I think a lot of times people within crypto you can argue all you want about like Ethereum versus Solana, But like, it's like, okay, well, wait a minute. Like, let's actually zoom out and say, are we actually paying? And I found that a lot of people, even the most like diehard bulls about a particular project and ecosystem would say, oh, were you telling me that I get like Revolut or Stripe is worth the same as Solana? I actually have a hard time justifying why Solana is worth that much. So it really disarms even the strongest of believers, because you just got to frame it in the right lens. And I think that's the whole intention behind this game.
Understood. Yeah, that's really, really cool. So oftentimes when you're having these conversations, what's like, where does this bias typically stem from for investors, given you're in a lot of these rooms that most people don't really have exposure to?
I don't, like, I guess you can point to a million things, but most of the time you hear like fund managers talk about like their bags. And of course, there's just an inherent principal agent problem there. Why? Because they're not investing all of their money. So when I invest in funds, I mean, I was at one and I've managed institutional capital before. But you always want to know like what percentage of the fund is your money versus other people's money, because I think that really just changes. Now I invest just my capital. So when I'm investing just my capital, I really just care about these things. But when it's other people's money, it's your mandate is to invest just in crypto. So you never want to acknowledge that like the opportunity set in crypto is just broken, which is where I come at it. And I've been a long believer since last year. Like I love the technology, I love the potential. I mean, I'm building Version, and it's like as bullish as it gets around the technology. But I hate the prices and I hate the structures that we invest in, which is tokens. And that is fundamentally broken. And so I think when you hear a lot of like VCs or funds that are just crypto only, of course they're going to say like this is the most investable, like the best opportunity to invest against. But it's like, well, what price are you paying? And what do you need to believe for this thing to compound at a higher rate than the S&P? Because like your benchmark's not just Bitcoin. It's, are you going to outperform the S&P? Are you going to outperform the NASDAQ? And very little funds actually do that. Like mean reversion is very, very real. Most hedge funds don't outperform the S&P. They might be hedging. So like, they deserve a place in a broader portfolio, family office or endowment or pension fund. But if you're a crypto investor, like you're 100% allocated to crypto. And of course, you're going to just debate the nuances between a Solana or an Ethereum, as opposed to saying, wait, as a whole, are these things just widely overvalued? And I come at it from a fresh perspective because I'm not managing anything. Like no one's money was released to investing in crypto, like through my family office. And Lord knows the numbers are out there, right? I think like I'm fairly active in the crypto universe, probably one of the most active angels. I put a lot of capital at risk, and I still am very overexposed to the industry. Like again, I continue to believe this is like the most exciting, one of the most exciting opportunities out there. But that doesn't mean that I'm going to like Ethereum at 350 billion. I hate it. I hate it at that valuation. And I think for whatever reason, I mean, this is like true with like in crypto, you see it very visibly, but it's also true for other sectors is, you can love the technology, you can love the company, but you hate the valuation. And somehow we're in a state where if you criticize the valuation, you are a non-believer, you're a heretic, you hate the technology, and so the discourse in crypto as a whole does not allow for just a good intellectual discussion of like, how do we, and I think part of that is like, how do you value these networks is also a broad question. Like, traditional markets have taken a broad, like more than a century to kind of converge on valuation frameworks around discounted cash flow and EBITDA multiples, and how software as a service, for example, as a category is totally re-rated. And it went from valuing it as a multiple of recurring revenue. That went down from 15 times when I was investing in SaaS before crypto down to 4. And not all of it was related to AI. And so I think like I mean, we're not going to find the answer in this podcast around how do you value these things. I think my pragmatic approach is, okay, like whenever you're looking at what the market thinks the value of Ethereum is, you say like, the market usually is right. Even though I tend to think the markets are incredibly inefficient, like the efficient market hypothesis is a fallacy. Like markets are not efficient, definitely not in crypto. But the market has converged on this idea that there are willing buyers and sellers of Ethereum at that price. So whenever you say, okay, that's wrong, you have to have a very pointed like reason as to why that is. I come at it from a, hey, if you were to value these things on a fundamental basis, you cannot reasonably ascribe a valuation for Ethereum or Solana or most other crypto projects, because it would be at an exorbitant multiple on cash flow, on revenues. But then, of course, like the critic says, dude, you're mid-curving this, totally mid-curving it. Even like fund managers, like you're mid-curving. And in part of it, it's like they are right in some sense, because not all of that, the value, if you were to think of like what percentage of a network's value is memetic? But certainly something like Ripple, a lot of it is. And that deserves credit. Like clearly, I mean, I'm not here to, you know, there's a willing buyer and seller at that level. And Ripple, you know, you could argue has less traction than other networks, but has commanded mind share. And, you know, like mind share and being able to capture attention has a lot of value. It's called goodwill in a balance sheet. The problem that I have when I invest my own money is I cannot hold something purely on goodwill and mimetic value, because that tends to be the thing that gets chopped the fastest when markets, like I want to invest in through cycles. I want to see, okay, what happens to this thing? And that's why most of the time investors, and I'll just round out this rant of mine, is you always want to look at the durability of a business based on supply and demand. And if you can't explain a business based on supply and demand and have a really pointed answer to that, then your analysis is just, you're going to be more likely to be panicking out of your, like, when the market takes a shit. And again, I always focus on the downside, because if I have a really good understanding that the business actually is very durable on supply and demand basis, that the demand for that product is high, and I feel pretty good that it's going to produce cash flows that support it, I'm going to love it if it goes down 20%. I'm going to love it if it goes down 40%. I'm going to love it if it goes down 50%. I mean, unfortunately, when you don't have cash flow to rest on, then it's like, okay, then I'm generally just believing that Ethereum or Ripple or whatever project is going to command the most amount of mind share. And that is a function of your TikTok strategy, you know, flows and other things that are like harder to underwrite, at least for me. But, you know, other people might have a really pointed Claude model based on social Reddit threads and, like, you know, make a killing off of that momentum basis. Like I'm not here to tell you that my method is the best. I'm just saying it simply works for me, because I want to underwrite things where I feel pretty good. Again, going back to the FDV.GG game that I put together, is like, I want to own things that I feel comfortable that I'm going to just, you know, rest easy at night and make sure that even if the market, even the economy turns, these are things that actually have staying power. So maybe that's the segment of the next conversation, just like what has staying power in crypto. Like we're seeing a lot of really good things work in crypto. And I think it's like the classic Silicon Valley meme. It's like as soon as things really start working, i.e. stablecoin adoption on the B2B side, and tokenization, like something like Figure, and to some extent prediction markets, it's like, well, what about the other stuff we were talking about like a year or two ago? Like what's happening there? Like, why isn't that gaining traction? Was that real? Was that cooked? Was that just fundamentally flawed? And so anyway.
No, that was a lovely rant.
I love that.
Appreciate it.
Kelvin, you're going to be dropping some more bombs for him. I could just listen to Santi talk for the entire time. It's great.
Seriously.
So to start unpacking that a little bit, one thing you said stuck out to me. So the way you approach things for yourself, for your money, for your fund, you want to hold something through cycles. Do you think that's relatively contrarian? Do you think that is how most investors or funds approach crypto investing, and most people approach crypto investing? Or do you think you're a one of one?
I certainly don't think I'm one of one. Like you're never one of one. Well, everyone is a one of one, but I do think that there are other folks that I think view it this way. I will come at it like it is hard to ascribe a valuation to things. But again, my position is, as much as I think the market is inefficient, I don't think the market's dumb. And so certain things that I pay attention to is, you know, I don't think anyone like logically wants to lose money in the market. everyone seems to think they have an edge. And the same way that if you ask like 100 people if they're like good drivers, most of them will tell you they are, but like accident rates tell you otherwise. And so again, the proof is in the returns. I think a lot of people in crypto haven't made money over the last couple of years. I think it's a function of the market maturing. If you're invested in like 3 different categories, you vastly underperform Bitcoin and just generally. Whereas in prior cycles, you could have just like punted everything that looked like crypto and you would have made money because it was hard. It wasn't institutional. So like if Bitcoin rallied, everything else had higher beta on the upside and very reflexive. That still is largely true, but like I think like just concretely, if you're invested in like Solana, if you're invested in Hyperliquid or some prediction market, you definitely did not perform Bitcoin. And Bitcoin is now, in my estimation, just branched out. And we shouldn't be thinking about crypto as a whole, as like a one category. I think Bitcoin, it pretends to be digital gold. It is a commodity. It should be valued based on supply and demand. Just look at flows. And so the way I think about it is it's sitting at 1/10 of the valuation of gold. Wall Street's now shilling it on end. It is going to, and now is a consensus holding in a portfolio. How much do you believe that's going to continue? And I think it will. And so, I think there is room for gold, for Bitcoin to continue to grow. Everything else pretends to be and is competing against flows and attention in the market against technology. Because I think we can reasonably, I don't think I'm seeing anything contrarian in the sense that Bitcoin is very different than Solana, Ethereum, Hyperliquid. Everything else that is a technology. When we talk about the future of finance, I mean that there are comparables, right? I think when we talk about valuation methodologies, one of, if not the most important valuation methodology, and it goes back to the FDV thing, is on a relative basis or on a comparable basis, right? So when you talk about Solana, migrating a lot of the flows from Wall Street, well, you're comparing against some, exchanges like ICE and NYSE and others, right? And I think that's a very, I would say that a lot of people still are adamant about saying, okay, Ethereum is only a subset of Bitcoin. So Ethereum has a ton of upside. Well, that's just fundamentally flawed because Ethereum doesn't compete against Bitcoin. I would say Ethereum competes against like other smart contracting platforms like, and I don't think that's it doesn't seem like it's like contrary in any, like I think most people would agree with that, but I think very clearly the market still kind of anchors to that view that you value Ethereum as a subset of Bitcoin, everything else is a subset of Ethereum. And can Solana become what Ethereum is? Can Hyperliquid converge on like Solana? And that's like it's shorthand. It's easy to value it that way. And then of course, like there's a unit basis bias, right? Like most tokens that are like Ripple is interesting because it's Bitcoin, but it's sub $1.
Yeah.
How many times have you heard that? A lot, right? That's right. By the way, this is like not new, right? Like it is well understood that like public companies do stock splits because it's a unit buy. Like you can't, and by the way, you can't own fractional shares of a stock. Crazy, right? In today's world, like you can only own one full version of the stock, and tokens similarly true, right? And so most stocks do stock splits. Most tokens have like massive token supply for this reason. So anyways, just I would say most fund managers are venture like, and so you hear folks talk about, hey, this is where the direction of travel is to tokenize everything. Go look at Larry Fink, go look at analysts. It's very clear. Go look at Figure. And I'm not disagreeing with that by any stretch of the imagination, but the question is, how much are you paying for that future to unfold? And I would argue you're paying a huge multiple for something that doesn't exist yet. And second, the durability of that, the competitiveness of layer ones is rapidly going away. Like infrastructure is rapidly commoditizing. I think we can all agree there's an excess, there's a plethora of block space, not enough demand for it. Long gone are the days where you had only one layer one or two layer ones, or now you have multiple layer twos, layer threes, you have, layer zero just announced zero, you have Stripe building Tempo, you have Circle launching Arc. Layer 2s, you have Coinbase defecting from the OP stack and building their own. I mean, I think time and time again, we've seen like the incentives of builders to go and build their own. I mean, at Inversion, we're thinking about building our own chain because, you know, we're buying businesses and make them more efficient with crypto. So we want to onboard them to our chain because I don't want to pay a tax to someone else. And so I think that the way I think a lot of investors are smart. They're thinking about, okay, what are the moats? What are the things that make Ethereum? Because candidly, Ethereum has commanded TVL, has commanded developer mindshare. Like there's reasons why you like Ethereum, the ecosystem, and you can still hate ETH, the token. But I will say categorically, I think we're going to see a lot of value destruction because the moats of these networks are not as strong as people would have them believe. For the simple reason that, like, you know, MySpace did not accrue value, and Facebook came along much later. And so first mover advantages, I think, are generally overrated. It is open source tech, so you can very simply copy. Like Layer 0 is an example. I was just with them last week in New York. They came at it from, they built the cross messaging system for crypto. And so they had a very good understanding of all the different chains because they were integrating with all. And they said, you know what? After all of that, I think we have an opportunity to build our own, which is now building on a couple of repos that exist out there, leveraging the best zero knowledge technology, some other stuff. They built their own, but they fundamentally, I think, have created something that seems to me like a pretty big breakthrough in terms of scalability and performance. And you might be saying that, yeah, man, but like all the TVLs in Ethereum, like developers in Ethereum, and you're like, well, not so fast because if there's like there's a violation analysis which says we've seemed to think that Ethereum has won the game, simultaneously believing that the future is going to grow like exponentially. And so if you believe that, then you also understand that like where are most of the flows and builders going to come? And I would argue it's definitely not going to be in Ethereum. It's going to be in something perhaps more like Zero. Why? Because the Layer 0 team just has better BD. They've worked with Citadel. They're working with Google. They're working with like. So I'm not here like advocating for Layer 0. I'm just saying like the moats of open source networks are, I would argue, not as strong as bag holders would tell you they are. And a lot of this is like theoretical, but I think you're seeing it play out in real time. Like Stripe launching Tempo was a pretty big sign of that. Layer 0 launching Zero is another big sign of that. So again, what gives value and what continues to give value to Ethereum? I think it's staying power. Like it's a brand in the same way that Coca-Cola has a brand, right? People like just it's mind share, right? And Vitalik and the developer ecosystem. But you know, I would say that if you believe this space continues to grow, and where's most of that growth going to come from? By the way, it's going to come from like Wall Street, you know, migrating over. You got to then fundamentally understand, okay, what is the incentive for a large bank to build on top of Ethereum versus build their own? Stripe already told you that.
No, it makes sense. And I'm curious, you touched on potentially building your own chain on Avalanche. Can you get a little bit more into detail about that?
Yeah, look, I'm not I'm in the business of finding the best businesses that I can retrofit with crypto. Because again, I fundamentally think that this technology is, you're working, if you're a business, you're operating under very antiquated financial infrastructure that has a pretty significant cost burden on your business. And when I go talk to CFOs and treasurers, they just sort of assume that they have to pay 4%. They sort of assume that they have to pay X to move money. They assume that it takes T+2 to move money and receive money, or T+20 if you're receiving money. And now that is no longer a fixed cost of doing business because money is moving in real time, and you see businesses like Figure totally collapse the cost structure of that financial workflow, which is they're focusing on home equity lines of credit. So they went in there, Mike, who previously built SoFi, says, listen, the underwriting process, the loan assembly process is incredibly inefficient. It's pen and paper. It's T+3. And then that has a whole drag. And Figure is now telling you where the future is going, which is they've lowered the cost to issue the loan and service it from $11,000 per loan to $700. That allows them to be more competitive to the end customer, but also service and issue lower loans, right? Because if it costs you $11,000 to do per loan, you can only you break even on a $350,000 loan. So there's a whole segment of the market that has a home that is worth $100,000 once they issue a $20,000 loan to pay for their medical bill, which healthcare is not getting cheaper, but you can't service them because you're in the. So there's Figure has opened up a market, and they're just they've built an $8 billion business on that, and it's become the largest non-bank HELOC in America.
Yeah, before I
This
pass
is
it to
one
Steven,
example.
I was going to
This
say
is
that was
one
a really,
example.
really good thread. Like that tweet storm that you had, just to inject really quickly. It was pretty thought provoking. So sorry, I didn't realize you were still going. Okay.
No, thank you. And look at it. Been following Mike and Providence and their, for years, and so that's a big inspiration to what I think. Like, it doesn't stop with home equity lines of credit. You can extend that to everything else in the financial system writ large. But it's going to take time. So my focus is doing that type of analysis and saying, okay, where else can I do that to drive massive multi-billion-dollar outcomes? And I want to buy businesses that have distribution, that I can retrofit with stablecoins, that I can tokenize their book, that I can make them vastly more efficient with this technology. A lot of it is cutting costs, and then some, like Figure, is expanding the ability to service other parts of the market because the unit economics are just fundamentally better and allow me to go and service other customers. And you kind of saw this in fintech, right? Fintech over the last 20 years have said, hey, traditional banks have a terrible app, don't understand technology, can't service customers. And if you're a young graduate that has only $1,000 to deposit in a bank account, JP Morgan is not going to cover you because they're not going to break even on you. And then fintechs came along and said, hey, wait a minute, we can actually do that because A, we think your income's going to grow, but B, we are we have very nimble teams, and we use technology to detect if you're going to be a good customer, and so we'll open a bank account for you, and it costs us like an order of magnitude less. So going back to your original question, like why Avalanche? For me, I again don't want to focus on the building a chain piece. I largely think that like the innovation on the chain side is like largely done. And so I just want something that is out of the box and is sovereign block space. It's block space that I own. Like, again, I don't want to compete for block space in places where there's people filling those blocks with Fartcoin and other stuff. So it's noisy. So in the same way that I want to go to a tax-free jurisdiction where I can just build, and focus on my business. And I think Avalanche provides that sufficient, guarantees and seeing other projects deploy. For me, it was interesting because it says, okay, this is as out of the box as it gets. And, you guys, when you think about like using software, I think you prefer to just use something out of the box that fits your needs and you can get off the ground pretty fast. And so for me, that was the driving force, which is using something like out of the box, like Avalanche, allows me to focus on my core competency and making sure that if I'm going to go buy a business and onboard and inject it with stablecoins and tokenize some of their book or whatever, I can settle on my own chain, and I can spin up my chain. I mean, while I was doing this rant, I could have spun up a chain. And so that's, of course you got to focus on some things, but to me, that's a pretty cool property. And I think you've seen FIFA, you've seen Gonzilla, you've seen a number of other projects in the Avalanche ecosystem that I went out to. I'm either an investor in those projects or know the teams well. And so we haven't launched a chain, of course. What I focus mostly on is, okay, what is the stablecoin transfer? Like if I'm going to onboard a business that has 100,000 users and they're not doing like high frequency trading, but they're doing some settlement. Like what's the blockchain footprint of that user? And can Avalanche credibly support that is it fairly cheap? What does a stablecoin transfer look like? And across all those dimensions, I get reasonably guarantees that it's a good choice for now. I feel pretty good. And the other thing is, I think change should decentralize, but the product teams and the BD team should be very centralized. I think Avalanche has a pretty good BD team. And that matters, right? When I want to get support, in the same way that if your Salesforce instance goes down, you can call 1-800-Salesforce. I think you can call the Avalanche team and they'll give you dedicated support. So that to me is also super important.
So you're in the business of finding businesses where you can rip and replace blockchain infra. So I'm curious. I find myself massively curious about your approach, just in general, because I agree with you. Figure is both the past and the future. Like when people say blockchain is going to upgrade financial infrastructure, like that is the Figure story. So then applying this Figure playbook onto different markets, and you're in a curious position where you've raised money. Now it's time, and you have been working at it, of looking at, okay, what market segments in the US or in the fintech world can get radically optimized. And I'm curious, one, how you approach that problem set. So what's the methodology as you look through? And then also curious on what the results have yielded so far. And then I've got so many questions as you go down this path. But we can start there because, for example, you think of healthcare. It's like, okay, that's massive market, but it's got its own obstacles. I'm just curious, as you rotate through each, how you find the segments to rotate through, and as you start breaking them apart.
Yeah, no, fairly systematic, because I think that both the challenge and the opportunity is like, where can you do this today with the least amount of risk and embedded assumptions? I think as an investor, anytime you start embedding assumptions like X and Y need to happen for me to get Z return, you're stacking probabilities, and probabilities that most likely you're going to overstate.
Risky.
Right. Yeah. And so the prompt, if someone wants to go out and compete, the prompt is very simple. What business can I buy today where I can make more efficient with this technology? And of course, the Claude will hallucinate because it is reading threads about, bridges of the world that will overstate what percentage you can cut on the transfer side. So that's where I think what's our edge? Our edge is that I'm staffing up folks in the team that really know A, how this technology works, but B, we're working in the field. Like we're going in, meeting management teams that have a willingness and interest to adopt stablecoins because they're seeing Figure and they're seeing Stripe and they're seeing others and say, hey, I want to do this. I just don't know how. Help me understand this. And so that's like why I started Inversion, and I've been building it for the last 12 months because it's timing is everything. And I think now you're in a state of the world where it's regulated with Genius Act, hopefully the Clarity Act. And so it's viable. So long gone are the days where I would knock on the door of a company. They'd be like, hey, listen, I don't want to talk to you because I'm afraid that a 3-letter agency will come knocking on my door. Just go away. Now it's the reverse. We have way more inbound from teams that say, hey, well, I've heard you on N talk about podcasts like this one. Help me understand it. Different from like integrators like a Coinbase or a Solana. It's like we're putting our money on the line, right? So we'll go with management and be like, hey, listen, we're going to put skin in the game. We're very motivated to drive outcomes here. We need to see alignment, right? So what are the businesses that we've looked at like 40 different segments. We've really narrowed it down to less than 5 where we're hunting. And so for me as an investor, so from first principles, whenever you see friction, I obsess about that. So where do we see a lot of friction? So cross-border trade, 41% of the S&P, 41% of the revenues of the S&P companies, like S&P 500, come from overseas. Anytime you're moving money cross-border, I put together this piece, go check it out on the website, the Inversion website, the Insights tab, is B2B stablecoins. That is the fastest growing of stablecoin volume. In aggregate, there's been like 15 trillion of stablecoins circulated every month, like in January. That's more than Visa and MasterCard combined. Visa actually has an adjusted figure that excludes MEV and on-chain stuff, and it's like businesses. It's $1.5 trillion of volume that is moving with stablecoins of businesses. That's real economic activity using stablecoins. 1.5 trillion. And so I actually, if you go to the site, I calculated like what's the cost saving if you migrate that to stablecoins. That's like roughly 1.25%. That's $18 billion of value that's been captured or that has been saved by using stablecoins. I mean, that's massive. And by the way, when I quote you that, I mean it's a sort of like the composition of you moving money cross border that has FX fees, that has settlement fees, working capital fees, and there's a whole set of like other things that go into that. So businesses that we like are ones where have a lot of cross border trade, have a lot of drag because they're moving money constantly. And so when that happens, the settlement is not T plus 0, with a stablecoin it's T plus 2 or 3. And that, as simple as it sounds, is a massive drag to a business because, the name of the game is like working capital. You look at a business that has so much of money in transit tied up for 2 to 3 days or more, 5 days, that's huge. Why? Because they have to finance that. They can't use that money in real time to buy more inventory. They have to have letters of credit. They have to have pre-funded accounts. So across the P&L, we kind of do a very quick x-ray of that business and say, okay, and which line item can we actually cut to what degree with stablecoin? So, remittance operators are interesting, payment processors are interesting, ISOs are interesting, FX businesses are interesting. Those are nice because they're more platform based, right? They're already selling into a vast majority of nodes, like end customers, and so you can save a lot of that and still charge the customer the same $10. But you instead of it costing you $6 or $7 to serve,
Right.
it costs you $3, and then you decide how much you pass on through to the customer. Similar to Figure, then you can be more aggressive, right, and do more. But we've also looked at businesses that are, we may do this in the future, but it's sort of a business like imagine an industrial company in the U.S. and it's importing fruit from Mexico. They're paying a lot in FX. They're paying a lot in cross-border. I mean, I'm not in the business of like maybe buying a fruit distributor in the U.S. Nonetheless,
Why not?
it's interesting. It's the upside's not as you got to go and buy more of these, and
Right. I guess the growth
value is
plan
there.
around it.
I'd rather buy more of a platform business where I can roll this out at scale. The beauty is that a lot of these businesses have been sort of left for dead. Like I mean, Western Union is a good example of this. I'm not gonna buy Western Union. Maybe not. This is too big for us, right? It's worth a couple $1 billion, but they have a lot of distribution. You have a lot of connectivity with the end user. Most people in the street, when they're thinking about sending money cross-border, they think about Western Union or MoneyGram, but Western Union. And that business structurally is very, very handicapped by moving money T plus X. Now they've announced a pilot using stablecoins. We'll see how far that goes. But I think when people ask me like, hey, I don't really get what you're doing, man. Like, I think you're cooking up too much. You believe in stablecoins too much. I'm like, again, well, go look at Figure. Go look at Klarna.
Yeah.
Go look at Western Union pilot. So I think it's the obvious question here is like, why hasn't anyone done this before? And
that was my next question: is who else is working on this? Because out of all the voices in crypto, I hear yours. Figure now has attention. I mean, I know the Avalanche BD team is cruising through stuff, and I'm sure some BD teams of other foundations around crypto are starting to staff up around where can you find revenue generating businesses, put them on chain. That's the basic mandate. But like, who else is working on this? Because it seems like very, very overlooked.
For now, yeah. So we're the only ones that are taking this private equity approach. There are some foundations that are thinking more and more about how to utilize their balance sheet to get more demand for their tech. I would say but I haven't heard of any like, Arthur Hayes has a buyout fund, but he's looking to mostly buy like broken VC backed companies that have a busted cap table. But they're coming for sure. I mean, I think private equity is in a tough spot. Most of the value that these guys like large private equity funds would have wanted to create is because the rates are zero. And they can put a bunch of debt on a business and fire half the people
a little too easy.
And grow that and have multiple expansion. Most of the money comes from multiple expansion. Multiples come down, right? Imagine if you're a large private equity fund, you bought a bunch of SaaS businesses at 15 times revenue, and now the market's at 4 times revenue in the public side. Like, you're not going to sell that at 15 times. Like, unless you've grown revenues and margin by like threefold, you're fighting up against like multiple compression. And so I think there's a huge backlog. But it's going to happen, right? I think I set out this mission to like prove to the world that we can actually take a business, make it more efficient. We've been at it for a while. I would say like 12 months. Would I wanted to move faster? For sure, right? But at the same time, like this is like a generational trade that I'm making. I think someone asked me the other day, it's like, say you do it first. Well, then every other private equity fund is going to want to do this. And I said, yeah, like I don't disagree with you there. And so what happens there? And I said, well, you either fundamentally believe, like the first slide in my deck is like, what do you need to believe to invest in this fund? A, you've invested in crypto before. B, you think that every business is going to use stablecoins. And if you don't believe that, politely fuck off. And I think that's the opportunity. Like every business is going to eventually migrate all of their flow to blockchain grids. It's not going to be straight line. It's going to be faster in some segments than others. There's certain industries where you can do this easier than others. Like I'll tell you, there are certain businesses I definitely don't want to buy today. And that's, I think, equally valuable in this process of elimination. But we like businesses that are not growing or left for dead. We're buying them at 4 or 5 times EBITDA. I'm looking at a business right now that is trading at quite literally 1 time EBITDA. 1 time.
Yeah.
And I look at that business and it could be made vastly more efficient with stablecoins. And it's like, I don't need much to believe. Even in a worst case where the Genius Act gets peeled back, the Clarity Act doesn't pass, we're back in a place where we can't integrate stablecoins. I don't lose my money. In fact, rare are the cases that you find that type of opportunity. So for me, I'm patient. I'm willing to be, I don't want to make a bad deal. And this is something that once you raise money, I think there's a natural trigger happiness that you have to deploy and you have to just kind of get going. I always tell my team, look, what we can't afford to do is do a bad deal. You want to always, like, we're in the business of like the 20% carry, not 2% management fees. So let's go find a business where we can really minimize the surface area of where we lose our money. And it's almost like if you're making a trade, what is a good trade? What is asymmetry in a trade? It's like, well, you can lose 20, 30% of your money, but you can make 8 times. That's a good trade. I would argue that most of crypto right now is like, you can maybe make 2x and you can lose 90% of your money. Yeah. So that's the opposite of what I want. I would argue Ethereum has way more downside than upside. Solana, similar. Like pretty much across the board, you see this dynamic. A lot of times people ask me, like, so why'd you change your mind? Like, you've been investing in the space, you've been sort of vocal about the technology. Why all of a sudden you woke up in November last year and said, these are all overvalued. We're going to look at them on a price to revenue basis. You were just fundamentally mid-curving it. Like, what happened? Just woke up one day and just realized this. And I said, well, no, it's not. It's this idea that where are you going to compound your money the fastest? And when I was investing in a lot of these protocols, they were worth 1/10 of what they're worth today. And I just, you look at yourself in the mirror and say, I cannot justify why I'm paying this multiple or this valuation for this particular project. It's just, again, going back to the discussion earlier, I think if you, as an investor, you have to constantly re-underwrite your thesis, right? Constantly. New information comes in on the daily. You have to decide whether you're going to act on that information or not. I mean, you guys are in the business of collecting a lot of that information and packaging that information. And so when I see someone like Stripe, again, build tempo, when I see where Klarna is deploying, where how other institutions are thinking about building on these rails and who's capturing that value, I say, okay, well, I definitely don't want to own L1s. Maybe I want to own apps, because apps are, commanding, like L1s still are 90% of the market cap in crypto, but their rev share has gone down from 60% to 10%, whereas apps now are like still like 10, 15% of the market cap and are capturing 60% of the revenue. Like, that's what I mean. Like, markets are not efficient.
Understood. And I kind of want to go back to the Twitter because I think you have an interesting je ne sais quoi when you're speaking about things. And one of the things you said was, if you don't write well, you probably don't think well. So what's one thing a lot of folks at home can learn from your work, as well as it seems like first principles that are instilled in everything that you and your team are doing at Inversion?
Yeah, no, that's a good question. I think definitely write more. Force yourself to just aggregate your thoughts. And if you can't explain this simplistically to someone that has no understanding of crypto, then you do not understand it well enough. I think there's no, like I always tell my analysts, like, I don't need a 15 tab, 3-statement model to understand if this is going to be a good investment or not. In many ways, I don't want that at all. Tell me where the market's wrong. Tell me how we're going to build value. And I think in my education as an investor, I'm hugely indebted to like other firms that I worked before, like at SageView and certainly JP Morgan. It's like, I think when you start off your investing career, you say you're daunted because there's so much information that you can package from a company. You continue to do analysis that leads to paralysis. And a good investor will tell you, hey, what are the 1 or 2 levers that you can pull in this business that are going to drive most of the value? And I think you have to have a strong pointed opinion. And that requires, I think, just repetition, and requires like building muscle and good judgment that AI is not going to outsource. I think AI very much like right now I can prompt it and ask it certain questions about a company, and then I think it's this idea that I think value more so now with AI is shifting to less execution. Like, can you do analysis, to can you prompt it correctly? Do you know the right questions to ask? Whenever you're sitting in front of a management team, whenever you're talking and to the machine, it's this concept that Albert Einstein just said: sort of focus on asking the right question. Focus like 80 to 90% of your time on formulating the right question. The answer will come easy, much faster in that 10%. And I think most of the time it's the inverse. I think we have this anxiety to come to an answer, and so we build complicated, fancy Excel models to like satisfy our anxiety. We want to like sensitize, every single line item in the P&L. It's like no, like zoom out. Like, so I probably will publish this, but I'm of the view that the best investors have a strong view on supply and demand dynamics for an industry. And I wrote about it just a little bit in the yield and uncertainty post. It was like, explain to me a business in supply and demand terms. Like, what is the curve look like how, like, fully elastic or inelastic? What is inelastic? Like the demand for rare metal that needs to be inserted in chips. Everyone's now a silver and copper analyst. So what does the demand for that commodity look like? So you could probably reasonably say, okay, well, the curve is fairly inelastic because the capex required to like mine these things is really high. Only very few people do it. It takes 3 to 5 to 7 years to like spin up a new mine. So that all leads to the curve is not super elastic. It means like if you Kelvin, want to overnight become a copper and mine it, well, you need billions, a couple $100 million, and you got to find the right place and zoning and whatnot. So it takes years. So the curve that influences the shape of the curve. Furthermore, then you think about, okay, what does the demand look like? Okay, well, you got to believe that people continue to spend in AI and data centers and all this stuff. And so I think, again, like it's as simple as like, what is it? When go ask them, like, what is the supply and demand for that, for your thesis? And if they can't give you like a really, really thorough, like start very high level and then just drill down to like, what does a curve look like? What does it look like historically? Why do you think it's going to look the way it does over the next 5-10 years or through cycle? And then what does the supply look like? And then are there any shocks to that? Right? And last, I think most people really understand, going back to crypto, right? Most people understand and are fully bought into the demand curve. Meaning, man, every institution is going to use this. You hear people talk about it. You hear Larry Fink talk about tokenization. So everyone is bought in on the demand side. We all can agree. There's no ambiguity there. There's reasons why that might derail on the regulatory front, but the direction of travel is very clear. But what does the supply curve look like? I think you make or lose most of your money by miscalculating the supply curve. So what do I mean by that? In this case, it's most people have assumed that it's really hard to spin up a layer 1 or layer 2. Most people believe that like the moats of these systems are really are high, and like the command, the barriers to entry are high, and that's just fundamentally flawed because building these sovereign states of Ethereum and Solana historically took some time, took a lot of engineering overhaul, a lot of deep thinking about how to architect a consensus system. But now, like, the supply curve is very elastic. Anyone can spin up a blockchain. So what is my generational trade when I started Inversion, and I still continue to believe in, is I want to be on the right side of infrastructure, meaning the cost curve is declining for block production. So I will benefit from that. There's more competition on the infrastructure side. There's $100 billion that have been invested in infrastructure for crypto. I love that. Whether it's Avalanche or something else, I can use a lot of these providers and technology to lower the cost to serve. So that, for me, I have a very specific view on what the curve looks like and will continue to look like. Like paying for block space is only going to trend in one direction. I love that because that means that I can cut more costs in a business that was paying orders of magnitude more in the traditional financial system. And what is the catalyst for that? Well, it's regulatory. And as simple as that may sound, it's like, that's why no one has done this. And so, yeah, I think as an investor, like resist, especially now, the temptation to like overly complicate stuff and build all these fancy models. Like execution is being commoditized, analysis is being commoditized. I think you have to understand where to look, and really, really understand things from a supply and demand standpoint. Like focus on that, especially on the demand side. Especially on the supply side. Demand is easier to understand. Supply is much, much harder. And by the way, the other thing is, as you think about, you would say, wait a minute, if everyone's an analyst now and anyone can spin up all this analysis on Claude, well, shit, markets are definitely going to become more efficient. And I would argue quite the contrary. Markets are only going to become more inefficient for a couple of reasons. One, there's an affordability crisis. So everyone wants to punt lottery tickets as opposed to the slow 4% compounder. So the market, because we have built these Robinhood systems where people can just very easily rotate money, the average holding period has gone down. And second of all, most of the flows are in passive funds, ETFs, right? And so there's only a very small subset of the markets actually actively managing money. And so that lends itself to inefficiencies. And you saw that very clearly in the SaaS apocalypse that is happening right now, which is the algos just sort of assume that AI is going to destroy software as a service. So like you see a massive, massive sell-off. And so the algo is not making a nuanced decision of whether ServiceNow, it sort of treats a super high quality like data lake and system of record in the same way that it treats a wrapper. Very different businesses, but it's bucketed as SaaS. And same with the people think about crypto as like Bitcoin and Ethereum, two very different things, right? But more so, what I tell my team is, I think you have to do the hard things that don't scale. Surface insights that don't exist online, and you will build massive value. That will always allow for excess returns. And what is that? For us, it's going in and talking to businesses and customers, especially because no one's really implemented stablecoin. So if you were to prompt Claude right now, say, find me the business where I can, cut costs, it will typically, like, everyone will now understand the 5 sectors where you can do this, right? Trade finance, remittances, and any sort of credit business. Okay, fine. But it will likely overstate by a wide margin the efficiency gain to be had, because it's scraping Bridge's website and Conduit's website and OpenFX. The reality is, you go in there, you go talk to these people, or go talk to the real business, you get their data, and that's where the AI will not solve that. And only very few people are willing to go that extra mile. And it has been true for the last, so many years. It's go talk to customers, go talk to real companies, do the field work that surface insights that don't exist online, and you will outperform. I think if you do that repeatedly, you will outperform. That is something that you can focus on in your process, because especially now, where most people will think that AI is going to give them the answer, and that's not the case. It will not. People will converge on that. By the way, you don't really understand the data that it's selecting for you. It's sort of like you just sort of assume God is speaking to you. And I think that's just not the case. And we see it all the time when we're doing real diligence on these businesses. We have to really, really pressure test. And we found that like AI hallucinates a lot, especially in things that haven't been done before. And if you're doing things that everyone is doing, you are bound to mediocrity. So you have to do the things that a lot of people are not doing. And especially what we're doing, no one's done before. So we definitely use AI a lot, but we supplement it with what we're seeing in the field.
I think there was a really, really interesting point I want to harken back to, because you can't really find this in textbooks at all. And it seems like earned wisdom, if you will. Asking the right questions is something that I know, at least on the liquid side, a lot of hedge fund guys tend to really think about as they're building out these crazy models and think about how to value things. Can you expound on your thought process as to how you methodically ask the right questions when talking to businesses, or just trying to understand how to make sense of the world?
Yeah, good question. I think, one, you never want to lead the witness, right? Sometimes it's good to play dumb. You should always play dumb and resist the anxiety to prove that you're smart. Man, the smartest guys I met are they pretend to be dumb. So I was meeting this guy who's one of the wealthiest real estate investors in the world, and you just kind of play dumb. And And I came out of that meeting saying, gosh, like, like, how did, that's strange. Like, how, it doesn't strike me as someone that's that smart. Guarantee that guy was as sharp as they come.
Yeah.
And so, but I think if you're young, cutting your teeth, you want to show that you've done work. You want to show that you're smart when you're talking in front of management teams. Like, but I'll give you an example. When I met Doe when he was raising for Terra, I met him out at Stanford, near Stanford. And he came to me and said, hey, listen, I want to build this. And I was an investor in Haven, which has then turned out to be Synthetics. And they actually pioneered this kind of stablecoin model, Haven. So I had some familiarity, and Doe had copied a lot of the white paper. And so I went in there playing dumb. And Doe had this ability to make you feel really dumb. He's like, how are you asking that question? Like, you clearly don't understand this. And I'm like, yeah, you know what? I don't. And I just really want you to simplify this. And then that became true over years. Like, I passed him around. Just didn't think he was someone that was willing to explain things in basic, like bare bones. And I probably came out of that meeting saying, oh God, he's really missing it. And then he pinged me then. It's like, oh, look what we built. Like, you missed out on a generational trade. And much later, I was like, okay, I'm going to re-underwrite my thesis. Seems like this is going well. Go talk to him. And I asked him like very simple questions like, hey, how's chai? Like, where is that volume coming from? Like, which merchants? Like, point to me to activity. Like, how can I verify this? And we asked him for diligence, like a diligence list of information to produce and furnish, and he wouldn't do it. But he had that ability to like point to you as like, you're dumb for asking this question. And I think a lot of teams do that because they're hiding behind that and they just don't have good answers. And so whenever that happens, just either walk away or press harder and harder and harder until you get a satisfactory answer. He never produced the satisfactory answer. Therefore, I never invested in that. And by the way, then I did channel checks. I talked to Kakao, which is a large merchant, e-commerce company. What is it? A mobile company. It's like a sort of, and they had good visibility. And I asked them, someone that was at Kakao, and said, hey, have you heard of these chai? They're purportedly, more than 10% of the, or I think at the time it was like 10% of like e-commerce stuff. And they're bumping up against the giants in Korea. I was like, wow, I mean, that's impressive if true. Go do a channel check, comes off negative. It's like, hey, we never heard of chai. We don't see it. Go talk to a couple merchants in Korea. Never heard of them. Another story. There's a, I remember Theranos, Elizabeth Holmes.
Yeah.
Okay. So again, similar personality. She went around the valley purporting that she had built this blood testing company, and everyone's seen the documentary. And I think it's she would point to like, hey, look, we have this board of directors, and in the board of directors are these like super impressive figures, like Department of State, and like Henry Kissinger's of the world and stuff. And I think a lot of people just fall a trap to that and just assume that because they don't actually do the work, right? It's like, oh, so-and-so is investing, must be a good company. I mean, you saw it in FTX very clearly too, right? So never loosen your underwriting standards. I think like, it's better to pass on a deal because it's moving fast. And, but if you haven't done the work, I think you're going to expose yourself. I've done my worst investments where I just are sort of like, outsource my diligence to someone else. Theranos, the funny thing about Theranos is when she was going around the valley, the only testing facility that had their Theranos kits or whatever was in Palo Alto, like in Silicon Valley. You could have gone to that pharmacy, tested it out, and understood that you got back to reading. And it was like it was like a white labeled Quest diagnostic. And you had done that, you would have understood that it was nothing proprietary or fancy about it. Now, that doesn't mean that she couldn't have built it, but it was just misrepresenting what was built. And if again, it's like she was raising at a very crazy valuation that assumed that she had built a lot of this. But, like, again, it's field work that really allows you to spot, avoid landmines. And I think most of this business is just avoiding landmines and just surviving long enough to have capital to make sure that, you're well capitalized. But it's really also just ask simple questions, play dumb, don't gloss over just very basic things. And if you can't really explain it to yourself, you can't write it in a way that other people understand, then I just think that you haven't really done the work, and you don't really fundamentally understand it. And the same with it, like, if you ask them, like, why is this network worth X or Y? Like, what gives Ethereum its valuation, or what gives Solana its valuation? What do you need to believe for it to hold true? Um, the nice thing about all of this is, like, I've met some of the smartest investors, and they're young guys, because they come at it from like a new perspective, and they don't sort of assume what is like dogma or established truths and principles. Um, so, anyways, I just think throughout my career, I've invested in like all kinds of businesses. When I was at JP Morgan, it was like from retail to metals and mining to technology, um, industrial businesses. Then I specialized in software as a service. And then certainly crypto, like, is just a great education as an investor, because you have to be both simultaneously a high frequency trader and a venture capitalist and manage risk. Whereas, like, if you're a venture capitalist, you never have to think that critically about portfolio construction and minimizing your downside. And so I think crypto is a really good asset class to like cut your teeth and like earn your stripes as an investor, if you survive and don't get liquidated.
So then, looping back to this question of how do you fairly give a valuation, how do you value things in crypto? So I'm working and helping a DeFi protocol right now. They're posting up strong revenues, growing. I mean, right now it's a shit market. What can you do? And for whatever reason, they want to launch a token. So the one question that they're stressing out over the most is, how do I pick my starting FDV? How do I, like, what is my valuation going to be coming out of the gate? Knowing what I know about crypto, its current market structure, its previous market structure, it's in this growing up phase. And as I'm sitting here listening to you and we're having this conversation, I just come to the realization of, I should pose this question to you. How, if let's just say you're running Athena before Athena, or some similar, cash flowing DeFi business that isn't hype, or isn't an exchange like a Perps exchange or prediction market. Like, how might you go through the thought experiment of, how do I structure this launch?
Well, having done IPOs, it really is what the market will give you. Now, I think that encompasses like how you launch it. Like Hyperliquid, you could argue a lot of the success was it was fair launch, it was community. A lot of it won over its customers, and so that created a lot of brand and staying power and positioned them to be what they are today. I mean, I think they built sort of a cult following. Not sort of, they definitely built a cult following. I would say definitely don't try to tick-top the valuation, because you never, first of all, you never control what the market will do, right? I mean, it's just quite literally, is there a willing buyer and seller at that price? And you fill the book. Like, if you're an investment banker, you sort of fill the order book, and you go out, you do a roadshow, you say, okay, hey, we're going to price this thing. Different from crypto projects, they have a track record of like 5-10 years of operating history, sometimes more. You say, hey, here's a profile of the company. Here's the discussion. Management goes out, does a roadshow, talks to investors, and investors will say, hey, are you want to bid 5 billion, 10 billion valuation, 20 billion? And you just fail the demand, right? And then so there's a market clearing price for however much you want to raise. However much you want to raise is a function of how much the market's willing to give you. So that's circular. So sometimes you see the price of that offering go up and down based on, the roadshow. But it ultimately comes down to two of how much is management willing to sell at that price. And I think sometimes I think that's something that you could point to, saying how much you actually want to offer right here. If I were doing it, I would say, resist the temptation to launch a token just because, everyone does it. I think,
let's say, and no shade to you or any of your peers, but let's say it's investor pressure.
Okay, well.
And also, just to throw stakes, like lower the stakes, we can also cut all of this, right? So, because the actual question is like, no, I mean, what, like, it's going to be a low flow, what coin, right? Like, people are on vesting schedules. There has to be some that's held by the foundation. Some's going to go out for a little points program / right? So, like, the game has to get played, it seems like, or in their opinion. They've already committed to a few things. So it's a bit more.
I wouldn't cut any of this. Like, these are hard questions. Like, there's a school of thought that says launch like fully unlocked, all investors just fully unlocked, just like let it rip, let the market decide how much it's worth. Like I actually am more closer to that. There's reasons why like structurally you wouldn't want it, like there's investors in the US and all that stuff. Like regulatory still plays a part here. I would say, like, again, say an exchange comes to you, because I think I haven't been privy to like discussions with exchanges, but say that an exchange would say, hey, listen, this is the price and we're going to take 2%. Hey, I don't know. You say, okay, fine. And they're going to, you go with market makers and they'll give you also a similar structure. And, I don't need to go into all those details. I'm not an expert on that, but I will say, like, say the value is X. I think you got to think about, like, is this actually worth what I think it's worth based on the traction that we have? And I think that's a more fundamental, like, honest assessment. The team just needs to, like, are we worth what the market's willing to give us? I could tell you, for when I raised for my project in the first round and the only round I've done, I didn't take the highest bidder because for a variety of reasons, but one of them was you should always leave some room for the market you want to grow into that valuation, and you want people that invest at that stage to participate in that growth and stick around. You could argue a lot of the Ethereum goodwill that's been created is because a lot of people have made a lot of money, and you want to create community, make shareholders happy. So if you have a choice of pricing at a lower valuation and a higher valuation, take the lower, maybe lower the amount that you want to sell. Now, in this case, a lot of it is funky because you have the foundation and you have investors and you have other different stakeholders. It's not a perfect decision. But I always caution, A, founders that obsess about price, because A, you can't control it, and B, allow your latest investors to make money too. So, grow into that valuation. But if it's a project that has, say, you could use comparable valuations. You would say, hey, look, we're a DeFi project. We're cranking out, this is the amount of TVL, or this is the amount of fees that we've been generating. We should be getting this type of valuation because we're a fraction of what Athena is doing, or we're a fraction of what Uniswap is doing, or we're a fraction of what Aave is, or Hyperliquid, and say, okay, well, I think that on a comparable basis gives you some idea of what the market will value you at. And if it's very disconnected or you can't justify it, I think you just really got to go back to the drawing board and say, okay, what are we doing here? It's probably very underpriced or very overvalued or somewhere in the middle, right? But ultimately, it really just comes down to what is the market willing to pay for that. But if it were up to me, I would leave some. A lot of times people say, wait, the IPO pops, like when Facebook IPO'd or some of these companies IPO, like Circle, it pops like 40%. You're like, wow, you just left so much money on the table. And it's like, yes, absolutely, but it leaves room for new investors to participate in the upside, and never, I've never been of the mind of you never want to price things to perfection. It just leaves more downside, and the worst thing is employees or new investors are down like 60% on the day. Like, maybe not the best idea to build community and brand.
This is 100%. A masterclass on first principles thinking. I really do appreciate that. That's all the time we have for today. I want to thank Santiago for joining us on this episode. As a reminder, our newsroom works tirelessly to get you accurate, informed crypto news. If you want to stay ahead, read the block. Thanks. See you next time.